Welcome to the deep dive. Today, we're getting into a real financial mystery, trying to solve one of the trickier puzzles in modern accounting. How exactly do you fit something as, well, groundbreaking and volatile as cryptocurrency onto a company's balance sheet?
That's a fascinating challenge.
It really is. Our mission for this deep dive is basically to trace the steps accountants take. They're applying this established rule book, IFRS International Financial Reporting Standards, to a completely new type of digital asset.
Yeah, and we looked at sources that really break down that thinking process, standard by standard.
Right, ruling things out, seeing what sticks. Think of it like being a financial detective. You found this new, unusual piece of evidence, crypto, and you need to figure out where it fits in the existing case file,
That's a good analogy.
So if you've ever wondered how accountants actually make sense of an asset that, well, doesn't even have a physical form, you're about to get a really interesting look behind the curtain. Okay, let's dig in.
So what's immediately clear, looking at the guidance, is that there isn't one single IFRS standard specifically written for cryptocurrencies.
No dedicated rule.
Nope. Which means accountants don't have a custom-made rule book telling them exactly what to do.
Okay, so what do they do then?
Well, instead of a direct answer, they have to apply the existing IFRS standards, sort of by analogy. They methodically go through the established categories: cash, financial assets, intangibles, trying to find the best possible fit.
Even if it means ruling several out first.
Exactly. Ruling things out is part of the process. This isn't just, acceptable. It's the expected professional approach when dealing with something new.
So it's less about finding a brand new rule and more about creatively interpreting the existing ones,
right.
Like legal precedent, almost.
In a way, yes. It's definitely a test of financial sleuthing, as you put it.
All right, let's start with what feels like a most obvious first suspect. My gut, and probably many listeners too, says cryptocurrency should be treated as cash. I mean, you can buy things with it sometimes. It feels like digital money, right?
It does feel like cash, absolutely. That's the intuitive reaction.
But the sources say that's not quite right. What's the key reason?
Yeah, it doesn't meet the strict IFRS definition of cash or cash equivalents. Those definitions are primarily in standards like IAS 7, which is about cash flow statements, and IAS 32, which defines financial instruments.
Okay.
So even though more businesses are starting to accept digital currencies, they're definitely not universally accepted as a medium of exchange. And crucially, they're not legal tender.
The legal tender point.
Right. Companies choose to accept them. There's no legal requirement forcing them to. Plus, IAS 7 defines cash equivalents very specifically. They have to be short-term, highly liquid investments, readily convertible to known amounts of cash, and subject to insignificant risk of value changes.
And crypto.
Crypto spectacularly fails on that last point. The price volatility is just far too significant. So no, not cash or cash equivalents for accounting purposes.
Okay, so despite feeling like money, it doesn't fit the technical accounting box for cash. That's a really crucial distinction, isn't it? Because it impacts how a company reports its liquidity, its financial health.
Absolutely. Major impact.
So if it's not cash, where do our financial detectives look next on their checklist? Maybe something broader, like a financial asset. Is that closer?
That's the very logical next step, yeah. But again, crypto doesn't quite seem to fit the definition of a financial instrument under the main standards, IFRS 9 or IAS 32.
Why not? What's the issue there?
Well, a financial instrument basically represents one of three things: cash itself, an equity interest in another entity, like owning a share in a company or a contract giving you a right or obligation to get or give cash, or another financial instrument. Think like a bond or a derivative.
Okay, like a share certificate or a bond contract.
Exactly. And cryptocurrency, just by itself, doesn't directly represent any of those things. Holding Bitcoin, for instance, doesn't give you an ownership stake in some specific Bitcoin company, right?
Right.
It's not an equity security. Now, the sources do point out that a digital asset could potentially be structured like an equity security, but your standard cryptocurrency like Bitcoin, no, it doesn't fit that definition. It's not a debt security either.
This is where the detective work gets really interesting then. Not cash, not a traditional financial asset. What on earth is it from an accounting perspective? We seem to be running out of the usual suspects here.
And this is where we land on the most appropriate classification based on the current standards. Digital currencies do appear to meet the definition of an intangible asset. That's under IAS 38, the standard for intangible.
Intangible asset. Okay, like a patent or a brand name.
Kind of, yes. Let's break down why. IAS 38 defines an intangible asset as needing three things: It must be identifiable, non-monetary, and lack physical substance.
Okay, let's take those one by one. Identifiable.
Identifiable means it's either separable, you can separate it from the company and sell it, transfer it, license it individually, or it arises from contractual rights. Cryptocurrencies are clearly separable. You can sell your Bitcoin, send it to someone else, trade it independently, so tick.
Got it. Non-monetary. That sounds a bit technical.
It relates back to the volatility, actually. IAS 21, which deals with foreign currency, helps here. A non-monetary asset essentially means you don't have a right to receive or an obligation to deliver a fixed number of currency units, like pounds or dollars.
Because the value of crypto constantly changes relative to traditional money.
Precisely. Its value isn't fixed in, say, US dollars. It fluctuates wildly, so it's non-monetary. Tick again.
Okay, and the last one.
Yeah.
Without physical substance.
That one's pretty straightforward, isn't it? It's digital. It exists on a blockchain, not as a physical coin you can hold. So, tick number 3.
Identifiable, non-monetary, no physical substance. So if I'm following our investigation, it fits the definition of an intangible asset. But it's still definitely an asset because there's an expectation of future economic benefits, right? You can sell it for cash later.
Exactly right. Cryptocurrency holdings can be traded on exchanges, which clearly points to an expected inflow of economic benefits. So classifying them as an intangible asset is the most appropriate path under current IFRS.
It sounds like accountants are essentially applying a framework, maybe designed with things like software licenses or brand value in mind, but applying it to this super volatile digital currency. What does that actually mean for how they value it on the books day to day?
Good question. Once it's classified as intangible under IAS 38, that standard gives 2 main options for measurement: the cost model or the revaluation model.
Okay, cost model first. Sounds simpler.
It is. With the cost model, you initially record the cryptocurrency at whatever you paid for it, its cost. Then, going forward, you carry it at that cost, minus any accumulated amortization, though we'll come back to amortization, and minus any impairment losses.
Impairment meaning if its value drops significantly below cost.
Exactly. If it loses value, you might have to write it down. Now, the second option is the revaluation model.
And that sounds more dynamic.
It is. And this is where crypto is a bit unusual for an intangible asset. You can carry an intangible asset at a revalued amount, basically, its current market value or fair value, but only if there's an active market for it.
Which there often is for major cryptocurrencies, right? Like Bitcoin, Ethereum.
Precisely. That's the key difference. Most intangibles, like a company's own brand name, don't have an easily observable active market price. But for many cryptos, they're traded constantly on exchanges.
So this is where another standard, IFRS 13 on fair value measurement, comes in.
Yes, exactly. IFRS 13 defines what counts as an active market, and you need judgment here. But for something like Bitcoin with huge daily trading volumes, it's pretty clear an active market exists.
And the quoted price on an exchange gives you that fair value.
It provides reliable evidence, yes. The company would need to figure out which market price to use, maybe the principal market or the most advantageous one.
So if a company uses this revaluation model, its balance sheet would reflect the ups and downs of the crypto's price more closely.
That's the idea. It arguably provides more relevant information about the current value, but the accounting for those value changes is, well, specific.
How so?
Generally, if the value goes up, a revaluation increase, that gain doesn't usually hit your main profit and loss statement straight away. It goes into other comprehensive income, or OCI, and accumulates in a special reserve in equity.
Okay, so it boosts equity, but not necessarily reported profit immediately.
Right, unless that increase is reversing a previous decrease that did hit profit and loss. But if the value goes down, a revaluation decrease or loss, that generally does hit your profit and loss statement directly.
So losses hit profits, but gains might just go to equity reserves.
Often, yes. Though if there's already a balance in that equity revaluation reserve for that specific crypto asset, a loss would reduce that reserve first before hitting profit and loss. It's detailed.
That is detailed. Wow. But it really highlights the potential volatility in reported earnings if a company holds a lot of crypto and uses this model. What about the asset's useful life? You mentioned amortization earlier. For a patent, there's an expiration date. Crypto doesn't expire.
Good point. Under IAS 38, a company has to assess if the intangible asset in this case, crypto, has a finite useful life or an indefinite one.
And for crypto.
Indefinite seems the most logical conclusion. An indefinite useful life means there's no foreseeable limit to the period over which the asset is expected to generate cash inflows for the entity.
So if it's indefinite,
then it is not amortized. You don't gradually write down its value over some arbitrary period like you might with a patent over 20 years.
Okay, no amortization, but
You must test it for impairment at least annually, and whenever there's an indication it might be impaired. So you constantly have to check if its carrying value on the books is still recoverable, if it's higher than what it's actually worth or could generate.
so cost or revaluation for measurement, indefinite life, so no amortization, but annual impairment testing. That seems to be the main path under intangibles.
That's the primary conclusion, yes. However, there is one other potential classification, though it's for very specific, narrow circumstances.
What's that?
It could potentially be treated as inventory under IAS 2.
Inventory, like stock a shop holds to sell.
Exactly like that. But this only applies if the entity holds the cryptocurrency specifically for sale in the ordinary course of its business.
So not just holding it as an investment, but actively trading it as your main business.
Precisely. The standard talks about entities acting as broker traders of commodities, or in this case, cryptocurrencies, if they acquire crypto principally with the purpose of selling it in the near future, aiming to profit from short-term price fluctuations or broker margins.
Like a crypto exchange or a dedicated trading firm.
Yes, exactly, those kinds of businesses. For them, IAS 2 says that such inventory should be measured at fair value, less cost to sell, with changes in that value going directly to profit or loss.
So for those specific businesses, the accounting is different again. More like marking to market their trading stock.
Correct. But it's crucial to stress this is a very narrow exception based entirely on the entity's business model and intent for holding the crypto. For most companies holding cryptos, say, on their treasury, the intangible asset route is the one.
What's really fascinating there is why the intent behind holding the crypto completely changes the how of accounting for it. It's like that same piece of evidence means something different depending on why the detective picked it up in the first place.
That's a great way to put it. Intent and business model are key in accounting classifications.
Okay, so given all this complexity, the different potential models, the judgments involved, especially around fair value and impairment, I have to imagine that transparency is absolutely critical here. What do companies actually need to tell us, the users of financial statements, about their crypto dealings?
You're absolutely right. Transparency is paramount. With so much judgment involved in recognizing, measuring, and classifying cryptocurrencies, significant disclosure is required. It's vital so that users, investors, lenders, you can make properly informed economic decisions.
So which standards mandate this?
Well, IFRS 18, which covers the overall presentation and disclosure in financial statements, is key. It requires companies to provide detailed notes explaining the information behind the line items on the main statement.
So they'd have to how they valued the crypto, which model they used.
Yes, absolutely. They need to disclose the specific methods, the significant assumptions they made, maybe about fair value determination or impairment testing, and the key judgments involved in classifying it as, say, an intangible asset versus inventory.
Makes sense. What about big swings in value that happen after the year end but before the accounts are published?
Good point. That brings in ILAS 10, the standard for events after the reporting period. It requires disclosure of any material non-adjusting events.
Non-adjusting meaning it happened after the balance sheet date, so you don't change the year-end numbers, but it's still important information.
Exactly. So if a company holds a significant amount of crypto and its fair value changes dramatically up or down after the year end, but before the financial statements are finalized, that would likely need to be disclosed in the notes. Why? Because that massive value change could definitely influence the decisions users make based on those statements.
So lots of required explanation in the notes to the accounts.
There should be, yes. Good disclosure is essential given the nature of these assets.
Okay, so we started this deep dive with what felt like a bit of a blank slate, a new asset class that didn't really fit. And through this process of elimination, really, and a careful interpretation of the existing IFRS standards, we've seen the quite logical, if complex, path accountants take to fit a volatile digital asset into the traditional financial reporting framework. It really hammers home that it's less about inventing brand new rules out of thin air.
Usually, yes.
And more about rigorously applying and interpreting the existing framework with, well, creativity, but also a lot of precision and justification.
Indeed. I think this deep dive perfectly illustrates just how critical analytical thinking and, crucially, the ability to substantiate your conclusions are in modern accounting, especially when dealing with emerging asset classes like crypto. It's a process, isn't it? Careful analysis, weighing up different options, making informed judgments based on that existing body of knowledge, and then explaining it clearly.
It really is. Well, that's a wrap on our deep dives into the surprisingly intricate world of cryptocurrency accounting. It's pretty clear that in financial reporting, new innovations don't always get their own bespoke rulebook dropped on day one.
Not usually, no. Takes time.
Instead, they force us to stretch, adapt, and sometimes really test the limits of the frameworks we already have in place. So for you, our curious listener, here's something to maybe ponder. Given how fast digital assets are evolving and how financial markets keep getting more sophisticated, what are the next accounting challenges likely to emerge? What new things won't fit neatly into the current boxes? And how will our established financial rulebooks continue to adapt? Or perhaps, where might they finally reach a breaking point and need a fundamental rethink?
That's the big question going forward.
Definitely something to think about until our next deep dive.